The U.S CPI inflation figures have arrived. We've seen a faster than anticipated cooling of inflation. The stock markets are soaring, bond yields have come down, and investors and analysts are now wondering, have we seen peak inflation? Today we're going to discuss the inflation report. We'll talk about the numbers and the unresolved questions. There's a lot for us to unpack. Welcome to the channel. First and foremost, looking at the numbers here, when we're looking back at it over the longer run, over the past 5+ years, as we know, we've seen elevated inflation from the back end of 2020 and 2021. At 40-year highs, we know the peak inflation level over this past period, the local peak was 9.1%. For this month, there was a consensus 8.7%. So analysts were still anticipating that we'd see a cooling of inflation. However, the actual print headline figure was 8.5%. We came in slower than anticipated, which of course has been good news for markets, which have been waiting to see a peak in inflation, a turnaround. We know that the Federal Reserve and other central banks have still been talking about transitory inflation, though of course it's much more persistent than has been anticipated. The core CPI came in lower as well, so it was a beat on both the top and the bottom line, but there's a range of different interesting nuances below that headline figure. When we're looking at it here, 8.5% on the headline. However, of course, it's not as if inflation's been solved with this one print. It's one print. However, of course, it's one component of many different data points that will continue to feed into many of the central bank decisions and the broader macroeconomic outlook. We're still running hot. As you can see here, the big drop-offs was in terms of the energy sector, negative 11% in terms of fuel. However, of course, we still see increases in terms of food. We still see increases in terms of shelter as well. And there's still uncertainties about how things will head, particularly as Europe and the United States, the Northern Hemisphere, head into winter on the energy front. And there's still those unresolved questions, particularly on the shelter side too. So yes, this month was good. It's a tick in the right direction, but there's still plenty below the line and cost of living pressures have not yet been solved. I'd love to know your thoughts, many contrasting opinions at the moment. Do you think we've seen peak inflation? Is the worst of it behind us? Or is this story only going to continue to evolve from here? We've also just dropped this second channel for investors, so make sure you've subscribed and turn your bell notifications on. Plenty more discussions to be had. Moving forward to the market reaction itself. Stocks higher, yields down. As you can see at the time of this recording, Dow jumps over 400 points. The growthier end of the market, which is more interest rate sensitive, the Nasdaq surged by over 2%, 2.5% up at the time of this recording. There's a significant amount of excitement, and in fact, the Nasdaq is over 20% up from the lows that we saw in the June period. We know that we've seen more of a risk-on tone in the markets over this past period. This report has only really helped to further catalyze that excitement, but there's still that discussion. Is this just a conventional counter-trend rally, a bull trap that's of course been sustained, but there's still ground to make up? Or is this something more significant? And have we perhaps seen a local bottom after all of the uncertainty and pessimism over the past few months to start off 2022? In terms of what happens now, there's a number of questions. First of all, the Federal Reserve rate decision. There's not going to be one in August. There's a break for summer. They'll be back in September. So that rate decision is going to have a lot of eyes on it. It was pricing in perhaps a better than even chance of a 75 basis point rise. We know we've seen 75 bips at the last two rate rise decisions. But now after this decision, quickly the markets and traders have started pricing in more than likely a 50% basis point rise instead of the 75 bips. We of course will get another set of economic data over the next month that will feed into their decision metrics. But it's also worth noting too that monetary policy operates with a lag time. We know we've seen 4 interest rate rises over this past period, central banks in a synchronized manner are rising rates, but it's not as if you rise rates and then you instantly see an effect on demand, the job market and everything else. And so then of course, a lot of the questions still surround this soft landing. Can they navigate it? There definitely does still look like a pathway towards a soft landing. We know over the past few months, that pathway was perhaps narrowing. However, there's been a few different reports over this past period that have indicated that maybe there is some opportunities there. There was a stronger than anticipated jobs report, 500,000 plus jobs added. Of course, inflation over this past period easing now might indicate that perhaps the worst of it is behind us. We know the Inflation Reduction Act is coming through. That in effect has the ability to be stimulatory, though of course it's dispersed over 10 years rather than being compressed into a shorter term time frame. So there are a range of different factors to consider. So then that brings us to what to make of it. Of course, nobody knows where things will head. As we know, the market's made up of bulls, bears, and everybody in between. Of course, as we wait to see how things evolve, everybody will be looking at the same sets of data and using their worldview, their own assumptions to inform their decision and where they think things might head. But here were 3 different opinions on the back of this inflation print that I thought were worth reflecting on. Firstly, we had Seema Shah, the chief global strategist at Principal Global Investors. They stated that the Fed will be looking at today's number with a sigh of relief, gives them a little bit more breathing room, but the Fed still has significantly further to tighten, and the US economy ultimately cannot avoid its fate. Enjoy today, the next few weeks, it won't last for too long. Interesting perspective. Then Neil Dutta, the head of economics at Renaissance Macro Research, stated the market's now pricing in a 50 basis point move, as we talked about previously, perhaps a better than likely odds of 75 bips. This data point will fuel talk of a policy pivot. We actually did a video recently, which we'll link at the end of this, talking about perhaps what the market was waiting for surrounding the Fed pivot, or when will rate rises end. But for Neil, the issue really does boil down to the labour market. We know the Federal Reserve is waiting to see signs of breaking or signs of uncertainty in that labour market as perhaps an indication that maybe they can take that foot off the brake, or perhaps they've started to raise into territories that might be restrictive enough. But wage growth at this stage is still running red hot. Absent a turnaround in productivity, this ultimately will fuel higher prices. And then finally, Mike, the Director of Investment Strategy at E-Trade from Morgan Stanley, stated this is a step in the right direction, but keep in mind we've got many miles ahead of us before inflation normalises. And that's worth noting. It's a better than anticipated print, 8.5%, but heck, that is still running at almost 40-year highs. We know the Federal Reserve wants to get to that 2 to 3% band sustainably, and so we're still got a long way to come down. 1 month's data point doesn't make a trend, however, so cautious optimism is likely the name of the game. I think that makes sense. It's a prudent call. I'd love to know your thoughts. Drop in a comment. Big thank you for joining us. For now, you can check out another video on the channel. Stay well and happy investing.